Test. Good afternoon, everybody. It's been a long day. It's been an intense day. We have the pleasure to host the last panel. My name is Martin Roff. I'm the CEO of the Manor Pension Fund in Switzerland and also the president of the Swiss Pension Fund Association. To speak in football terms, I think we have here a Champions League group of asset owners, asset managers and regulators speaking about the challenges of or understanding the climate implications on return and risks of long-term portfolio assets, real assets. I start with Vanessa Harvard. Vanessa is from Transition Finance Market Review UK. She will introduce herself later on. Then I have Sold Kohalmi, Global Head of Real Estate and Deputy CEO, Pictet Alternative Advisors. To the left, I have Jean-Christophe van Tilborg, CIO of Retrait Populaire and sponsor of this workshop. To my right-hand side, I have Emmanuel Jacquelot, Executive Vice President and Head of Infrastructure from La Caisse, Quebec, in Montreal. I just learned that. Last but not least, I have David Livingstone, Chief Strategy Officer of Galvanize. Maybe first I would like to start with a question to everybody. To get us started, I would like to introduce yourself briefly and to talk about the topic of our workshop. So long-term risks, be it in infrastructure, be it in real estate, credit, be it in regulation, be it from a pension point of view. So where do you see the biggest risks? Of course, risk is not only negative. You can talk also about opportunities you're seeing in the market. And how do you face those challenges on a risk management, from a risk management perspective, as well as from a management perspective per se? So maybe I'll start first with regulation. Vanessa, talking a bit, I know the UK market is a bit particular, but how does the UK address those challenges when it comes to regulations? And maybe you could start with introducing yourself and your role, please.
Okay. Thank you all for coming, especially at the end of the day. So I'm Vanessa Harvard-Williams. I'm a reformed lawyer, sorry. And I am here because I was asked by the UK government to lead a review called the Transition Finance Market Review. And the homework question we were asked was, how can the UK become a hub, a centre of excellence for transition finance? So financing the transition for ourselves, but also globally. Turns out it was quite a hard question. Anyway, we reported at the end of last year, in October last year, and part of the process that we recommended was the formation of a Transition Finance Council, which we copied from other countries, I have to say. We are 6 months into the Transition Finance Council, and I am leading a working group that is focused on developing transition finance guidelines for public and private finance across asset classes and potentially operable globally. But going to your question. In terms of the asset classes that are most exposed in the UK, I'm just going to talk about the UK because otherwise I'd talk too long. In the UK, it's
more than welcome.
It's typically privately held assets that seem to be having a tough time. And it's happening at two ends of the market. So we've got high emitters and some climate solutions companies who are in difficulties, The high emitters are for a whole bunch of reasons. This is sort of layer cake of problems. And certainly carbon costs are one of those, but they're often not the only ones. In the climate solutions space, it's often because the policy environment has not been correctly developed. And on the east coast of the UK at the moment, we are losing, well, we've got 2 steel companies in difficulties, we're losing a refinery, and we've got 2 biofuels companies in difficulties, and that creates social unrest. So that is a big problem. And I think also we're seeing business models affected by physical climate change, and the water companies are a good example of that. Obviously, that's a much more complicated situation. So that's a UK pessimistic answer. You've got to ask me an optimistic question next.
I'll do later on. Thanks a lot. Maybe starting to my left again, Salt. A short introduction, please, and your point of view when it comes to this topic.
Thank you very much. So good afternoon, everybody, and I just echo Vanessa, thank you for holding out. It's the last session of the day. So I work at Pictet, and essentially in the alternative advisors side, which is essentially responsible for private assets. We make solutions that involve both direct investing, co-investments, as well as multi-manager solutions. In everything we really do in private equity and real estate, there is always a sustainability angle. If it's multi-manager, it will be reviewing what the manager is doing and aiming to pull them into the right direction. And on the direct side, we are the investors ourselves, and we're looking to create investments that we believe are long-term. And I think that's the motto of the day. If you're looking to create long-term solutions, then you want those assets to be sustainable. And I always feel, being on the Pictet Sustainability Board, that one of the easiest places to do that is real estate, because real estate is one of the largest emitters, has a big obsolescence problem, but on the flip side, has an obvious premium once you're coming to exit. So you can really, very, very rare in today's world that you have actually the numbers that allow for the sustainability to go hand in hand with profits, which is what we always talk about. And just some stats for you there. Cushman & Wakefield did a study recently. There's now a 27% premium for the same building if it's green versus brown in the same location. But importantly also the offtake. You want to create objects of desire. We're value-add asset managers. We want to sell eventually to low-cost capital, long-term holders of assets. And there's a desire to be sustainable, but also to go from brown to green. So that's I think the good news. But to maybe go glass half empty, as Vanessa said, maybe talk about a few of the long-term challenges that I see. I just mentioned 2 points, perhaps briefly. One is the effect of climate change on climate adaptation of buildings. And we're seeing in real time the problems, the hurricanes that are coming around Florida, the wildfires that are coming around Athens, for example, that you can't open your windows now for weeks in the summer. And my personal favorite, by the way, here in Geneva, air conditioning is illegal. And we had the dome here like everybody else, and I don't know of a single person who wasn't suffering in Geneva due to the heat and because of the insufficient cooling mechanisms that we have today. So I think that's one big area that's a big issue, and at the moment it's slightly hidden by the fact that insurance still works in many locations. The next phase will be you will see insurance fall away. And as insurance falls away, you will have a big adjustment in values. The Economist wrote an article about 2 years back about how Miami / Florida being 40% overpriced in their estimation if the insurance was not available going forward. And then the last point, maybe long term, I think is also where we're going to live. I think it's very counterintuitive today that some of the hotspots where people are moving are places like Athens, as I mentioned, the summer issue of wildfires, but Dubai as well, right? We have locations that people are moving to counterintuitively, but this will change. And I think what's interesting in real estate, over time you will see certain areas become more popular because they're more sustainable, because there's, for example, less heat. But where you already see it today, I think is interesting, is in hospitality. And just one anecdote for you, an example I really liked. Last year, the Irish government started a campaign where they said, come to Ireland, it's 16 degrees and it rains guaranteed during summer. And it worked. You know, they have a massive tourism because people are finding it hard to holiday in the Med.
Thank you. Yeah, fully agree with you on that. I mean, Switzerland, we have the other challenge. We have a skiing tourism, which is in some parts of Switzerland no longer skiing. So you need to invent yourself as well there. Maybe just one follow-on question. If I get your statement right, you're saying that those effects are today already priced in. For example, when we talk real estate, that some of those effects, when you have a brown or a green real estate asset, it's already reflected in the pricing.
Well, as always, life is not that easy. So unfortunately, the word "it depends" is probably appropriate. I think that it is very interesting to me that, you know, again, if you create a green building in a strong location today, you will get liquidity and you will get a premium for it. And it's because all the end buyers, the long-term holders, insurance companies, pension plans, are looking for sustainable buildings in Europe. In the US, I find it very interesting. There's no ESG, as we know, but they talk about modern buildings now. Modern is the equivalent of a sustainable building. It happens to actually have the same score, but where you don't see this appropriately priced in, I think as it relates to climate change. Again, Miami is still at record prices, and people literally, there are now areas. If you know Miami well, Fisher Island is just off Miami. There is no more insurance available, so you are buying a home that the next hurricane that comes, it's almost an if, when, not an if. That will take it away, and that's part of your equation, and I don't think that's appropriately reflected in the price.
Okay, thanks a lot. So, David, we were talking before, you were talking about opportunities as well. We from the pension fund side, we're more focused on the risk, of course, on the opportunities as well. But maybe I guess you see a lot of opportunities out there in this transition. Maybe also you can start by introducing yourself and talk a bit about how your company is approaching the transition topic when it comes to real assets.
Absolutely, thank you. So David Livingston, I'm the Chief Strategy Officer at Galvanize, which is a multi-asset class, multi-strategy asset manager specialized in energy transition and industrial transition opportunities across those asset classes. I came to Galvanize last year after having served in the previous administration as senior advisor to Secretary John Kerry, who's at the firm as our co-executive chair, and had previously worked in the Obama White House on trade as well. Let me say, I come at this indeed as a bit of a glass half full person. That is both dispositionally because I'm a Californian and because of where I sit, which is based in San Francisco in our headquarters. I mention that because I think San Francisco is emblematic of actually two of the key themes that connect this event here today. Number one is, as mentioned, unlike parts of southern Florida, I think of San Francisco as actually one of our most climate resilient cities in the U.S. and perhaps in North America. It's a place that probably would benefit from 1 or 2 degrees warmer, even if it's remarkably actually quite sunny all the time. And it's also, though, I think even more importantly, a place where I think we take a uniquely long-term view, because people in California and because people in San Francisco and Silicon Valley in particular are literally mentally living in the future, right? It is a place that, both to its detriment and to its benefit, in a way that's sort of the American mind on steroids. You have this almost complete disconnect from any sense of historical inertia and a obsession with the future and why not instead of why, right? Why not? And I mention that because I think that there is not too much, but a healthy strand or two of that DNA infused into our own firm and infused into the way that we think about this opportunity set. So let me just get the risks out of the way by saying I think oftentimes the way that we think about it as a firm across our investment strategies is the only risk is not moving fast enough. The only risk is just not seizing those opportunities that are standing in front of our faces quick enough. We literally think across multiple different asset classes that there are $100 bills lying on the ground, and the risk is not going to scoop them up fast enough. Let me give you a couple of examples. In real estate, which I think is a great one to build off of, you're absolutely right that there are a number of different strategies that exist in Europe that are leaning into taking buildings, decarbonizing them, delivering net zero buildings to the market that are clearly desired by ESG investors. No such strategies exist in the United States, or at least didn't exist until we developed one that's focused on industrial real estate assets in the United States. What we do is we identify industrial real estate assets that have high potential, but are oftentimes extremely energy inefficient. So one of the buildings we recently acquired was a manufacturing facility that had in terms of leakages throughout the building systems, underground, walls, ceilings, et cetera, leakages throughout the building system, the building's various systems, that were equivalent to the energy loss of having 2 mattresses blown out of the wall in terms of energy loss. We acquire those assets for below replacement value, and then we execute a kind of proprietary energy efficiency, resilience, and sometimes behind-the-meter generation strategy on the asset. Now that does several things. Of course, it improves the cash flow on the asset by reducing water costs, reducing ongoing energy costs. And that, by the way, is the only thing that we in the end underwrite for. So even though we take the building net zero within 3 years, we only underwrite for improved cash flows, because we want to underscore this idea that you don't need to count on some theoretical green premium manifesting to make this an attractive investment. We believe there are compelling returns to be had where the right thing to do from a decarbonization perspective is definitionally aligned with saving money on the asset and making it more attractive for potential tenants. The other things that we do, though, are with behind-the-meter generation on the asset, you build optionality into the asset, especially in markets. We tend to be acquiring and renovating these industrial assets in strategic logistics corridors of the United States that, oh, by the way, are also oftentimes where data centers are going in. What that means is you have significant upward pressure on power prices in these markets in the years to come, which not only increases, of course, the value of the energy efficiency savings, but when you put solar and storage on that asset, you also give it option value in the market going forward, where it could, sell on, expand, sell to its neighbors, et cetera. The final thing that I mention is, again, in a very Californian comment, we believe this is also about future-proofing the asset. So what we tell people is, if we want to take this from a tenant that was kind of low value, happy with an energy inefficient asset, and we want to prepare it for the Amazons, the Walmarts, the most advanced manufacturing tenants of the world to come when we release it out, we want to make sure that the power systems are upgraded. We want to make sure that that asset is ready for someone who's not bringing an internal combustion engine truck, but an electric truck in for loading and unloading. We want to make sure that it's ready for increased automation. In 2030s, in the early 2030s, we want to make sure it's ready to have a fleet of humanoid robots, occupying that factory and or that particular industrial asset. So it's also about future-proofing it as well. So there's kind of a triple-layer approach to value creation, and again, in the American context, we're really leaning into that value creation framing. We also have strategies across public equities, venture and growth, as well as a new strategy that was just announced 2 weeks ago in credit and capital solutions. And I'll just say in 2 lines and then move along, but just say that the credit capital solution strategy is so exciting because contrary to kind of the headlines that you hear, the opportunity is created by the dislocations in the market as a result of President Trump and some of the changes that are happening to the Inflation Reduction Act. In other words, the Department of Energy is stepping back from issuing loan guarantees to a variety of different clean energy projects and companies. And in that wreckage of $200, $300 billion worth of pipeline that's no longer going to have a chance of getting a loan guarantee from the US government, we've hired the Chief Investment Officer, Deputy Chief Investment Officer from the Department of Energy in the previous administration to help us sift through the wreckage, find the most attractive and creditworthy companies and projects out there. And we're able to offer them very flexible, nimble, creative capital solutions that we think can create, lower private equity-like returns, but without any enhancing of the risk profile.
Thanks a lot, David. So if I get you right, the opportunity set is vast. A lot of opportunities out there. Emmanuel, David just mentioned he's afraid of not moving too fast. How do you see it as a representative of a long-term investor of a pension fund? Are you not moving too fast, or what are your biggest challenges when it comes to ensuring long-term cash flow for real assets? And maybe also, a short introduction of yourself.
Sure. Good afternoon, almost good evening. So Emmanuel Jacquelot, I work for La Caisse pension plan of Quebec, so $500 billion. I'm in charge of the infrastructure portfolio, which is about 70 billion Canadian dollars. It's mostly a direct investment play that we have. And I'm also in charge of sustainability of the overall La Caisse portfolio. So I think we're a pension plan, so we don't define ourselves as a fast mover. I think we are meant to be prudent about our investment, which doesn't mean I agree. Does mean I agree with everything you said. Nevertheless, I think looking at infrastructure in particular, much like what we just heard on real estate, it's the debate of this twofold about climate. There's the impact the climate is going to have on the infrastructure per se. How do you future-proof them, to your point? I think it's slightly more complicated with infrastructure because they can be decentralized. If you think about a telecom tower or wind turbines, it can be roads, railways, ports. So you're addressing a much wider variety of climate risk, and some that you don't think of spontaneously, and that you discover, unfortunately, by experience. And I'll share one example, which actually happened in Texas in 2021, which was a polar vortex, and it froze basically the gas grid and the electrical grid there, and actually 200 people died from cold. In Texas, in the US, in the 21st century. And we had a couple of wind farms there that froze as well. And the bulk of it, despite what you hear, is the gas asset froze, and that caused most of the impact. But we couldn't prepare our wind turbine for this event. We have turbines working in Canada, in Sweden, in Norway, where they withhold minus 20 degrees very well. We didn't pay for the weatherization option for those turbines. It costs an extra $100,000 per turbine. We didn't think it was a good call. Actually, it never came up to my attention that we had to make this debate, right? Turned out that would have been a good idea to save human lives, positive externality, but also for our bank accounts. Electricity price shoot up to $9,000 per megawatt hour. Normally it's around 40 or 50. So we would have paid off those weatherization option in matter of hours, right? So that's one example of something we didn't think about. Don't associate cold with Texas, especially when you look at it from Quebec, which is good 4,000 kilometers north. So that's just one example. So when you do the systematic future proofing of your asset, and you can use a lot of really intelligent tools to do that, you discover some of those vulnerabilities. And the good thing that we don't need to go fast, but we need to be resilient. So we have time to fix these assets, to future-proof them, and we believe it's economically a viable option to do. And the second thing, and I'll finish here, is that's on risk, on opportunity. Quickly, I think infrastructure is far less advanced than what I just heard about real estate. I think the market is pretty efficient. Infra market is not efficient. You buy a gas utility in the US, same value of the same valuation as an electrical utility. It's in our view, and I think it's we see a whiter future, greener future for electricity than gas. So we're very happy to buy more electrical utilities and gas utilities these days. So that was an example of the opportunity set. I would say thanks to the current government of my neighbor here, it's a good time to buy renewable assets, somehow, if you believe in the long-term benefit of renewable energy. And we do, not as a morality belief, but as an economical belief. And we've been buying this year, we invested in nuclear power plant in the UK. We've bought 2 renewable developers, one in Canada, one in Australia. This is a great time to invest. So that's a great opportunity when you have a little bit of volatility in the politics. So I'll stop here.
Thanks a lot. By the way, it's by chance that those guys are sitting next to each other, Canada and the USA, but it shows that America. They have a common understanding. Jean-Christophe, being one of the major pension funds in Switzerland, you have a long history investing in real assets. You I think, recently started in infrastructure, if I'm not mistaken. So, where do you see the biggest challenges in modeling the future cash flow, the long-term returns for those asset classes? And again, if you could just briefly introduce yourself.
Thank you. So Jean-Christophe Van Tilburg, I'm Chief Investment Officer of Retraite Populaire. Retraite Populaire is an insurance company in Lausanne, but also a platform to manage public pension fund. So we roughly manage 30 billion Swiss francs. So as Martin said, we have a very large real estate portfolio. It's by history, it's about 25% of our asset allocation, which is about 8 billion. So one of the challenges we face at the moment is, of course, because of the history, we have a collection of very old buildings. So 20, 30, 40 years. So now, of course, it's time for renovation. And of course, it's a lot of cost. So a few years ago, our board of directors decided to speed up the process in terms of renovation. So it's about 3% we will spend on renovation in the next few years. The objective is to reduce 1/3 of our carbon emission in the horizon of 2030. So we have 5 years. The issue we face with renovation is because of the regulation we have in Switzerland, we cannot pass through all the costs to our tenants. So when we have to renovate one building, one of the challenges we face first is to get a permit. So very, very slow in some cases in Switzerland. So we want to speed up the process, but at the same time, it's a very long time to get permit. When we get permit, in order to improve the return of the buildings we renovate, sometimes we try to add an extra floor just to make things in a better way. But it's not always possible. So there is cost of doing the renovation, but if we don't do that, we'll go in 5-10 years, we'll have very old buildings, and we have to invest a lot of money. So it's a very long-term process, but for us, it's really to maintain the value of our flats and our different buildings. So it's one of the big challenges we have. In terms of infrastructure, it's an asset class we have for about 5-6 years. But we made a partnership a few years ago with Danish pension funds called AIP to invest in first transition energy fund. Why we did that? We do that. It's we recognize that with pension fund and not asset manager, we have, and no offense against asset manager in the room, of course, but we found out that we have better aligned of interest for such a long-term asset class. Of course, you can imagine that it's also a very cost-efficient way to invest our money. But it's really a very interesting experience. And last year, we did another partnership with our Swiss pension fund with Lacaisse, also to keep growing this asset class, because for our clients, in terms of climate strategy, it's much easier for us to explain what we do with an asset class like infrastructure, or what we do in real estate. Because when we have to explain what we do with engagement and exclusion, whatever, it's more difficult. So the narrative is with infrastructure and real estate is much easier for us.
Thanks a lot. So from your point of view, then, the regulator is not moving too fast, I would say, when it comes to renovations, etc. But also I can confirm I have two hats on with a pension fund and the association. And I mean, I think in every country, real estate is where it's really happening at the moment. Just to give you a few figures, I would say an average pension fund in Switzerland has about a third to 40% exposed to real estate and to infrastructure. And of course, this is where you have the most direct impact. So I see all my colleagues, like Retraite Populaire, like other pension funds, they are working hard on their portfolio, trying to find a smooth renovation strategy economically and ecologically. Maybe a question there to you, follow-on question to you, Jean-Christophe. You said you decided to invest about 3%, I understand, into ecological renovation. Does this renovation also capitalize when it comes to uplift in valuation of the buildings, or what's your experience there?
So when I mentioned 3%, it's 3% of the value of our real estate. It will be invested in renovation. So it's
okay.
And so I don't have the number, but there is a slight 1% is really spent and just to renovate, and the other is passed through to improve the income from our real estate. So on the long term, when we renovate based on the valuation guidelines we have at the moment, because it also can change, because why we use the same guidelines for some pension fund is renovate more quickly and another is do nothing. So we'll see on the long term, but I think, I don't have the number, but the renovation process we have has an impact and really reduce the return of our real estate on the short term.
Mm-hmm. But not on the long term, we agree on that, yeah, for sure. Maybe we are already in the middle of the discussion. We discuss a bit different asset classes. Salt, you being responsible mostly also for real estate, foreign real estate. Do you see, first of all, you already a few minutes ago mentioned what's happening, but you're now resident in Switzerland. Is there a big difference what's happening in Switzerland when it comes to managing those long-term risks compared to the rest of the world? Maybe your thoughts on that.
So I think when we started off, when I started long-term, I was thinking 50 years long-term, what I was talking about. I think everybody else has been talking about, the 5 and 10 years. So maybe let me perhaps just rewind and maybe give you a few stats as to that. And I will start by saying, by the way, that for those of you who are perhaps not, daily looking at real estate investing, is that Switzerland is on a different clock than the rest of the world. So we have the world being Western Europe and the US suffering for the last 2-3 years, with obviously cap rates and interest rates being directly correlated, and you've seen an incredible value drop, which we'll talk about that in a moment, makes sustainability harder, because you're trying to invest into a falling value asset, which obviously has not been easy. But Switzerland, Dubai, and Tokyo, and Moscow have suspended the laws of physics and have had really interesting value growth in the meantime. And obviously, again, when you take the correlation with cap rates, it becomes obvious why, right? Switzerland, we're at 0 interest rates. So by definition, in a zero interest rate environment, real estate often acts as an alternative to fixed income. So by definition, you're getting yield for your pension plans, which is great, and you're getting yield way in excess of what a money market fund could offer. In Europe and in the US, money market funds have been very much a la mode and have seen great inflows as a result of some of the, partially as a result of real estate struggles. Back to your point, I think the other bit that I found interesting, and almost everybody's touched on it, is 91% of European buildings were built before 1990. So the sheer size of the task that we have ahead of us is crazy. And then on the other side of this, and we have a regulator here with us today, the regulation in Europe and Switzerland is incredibly ambitious. We're saying that you will not be able to rent an office building that's below EPCC rated in Holland by 2027. And so this requires value-add investors such as ourselves to come in, take a building, 30 to 50% improve through various measures the building's energy efficiency, and then release it. But the reality is there's no way that mass of buildings can be redone at the speed that the regulators think. So we're faced with something very similar that many of you will have seen in the UK in particular. It's a big conversation, is electric car adoption. It's a similar problem. So this is not going to happen at the speed it should happen. I think the good news is that there is a premium, but if you're an asset manager and you're looking at investing into a new asset, you will probably look at 20 to 30 buildings till you find one where that energy transition is economically positive. And so that's something to be aware of, that the metrics are still challenging. And to find that asset where once you've done the conversion, you will achieve a premium is not that easy. Is that perhaps helpful context? Okay, thanks a lot.
We were talking about regulation. So what do you think, in which asset classes, and we're talking again the UK, but UK also when it comes to private markets is a benchmark in Europe, one could say. So where do you see the most impact for regulation, or where does the most regulation need to be done?
So where we're having the most impact at the moment in our regulation is through the carbon budgets, and particularly in the renewable space, where we have super ambitious 2030 targets that are being really actively managed. And this is a real cause for optimism by government, by the sector, by the investor community, by the supply chain. And they are working through and prioritizing projects for grid connectivity, for example, so that they can get to what they need to get to by 2030. That seems to me to be an example of sector transition planning at its most effective. Actually, we need to take that and look at it in other infrastructure areas. And when we did the review, the feedback consistently was the issue is predominantly real economy policy, ensuring that it's investable. That's not necessarily about incentives. It's about making sure that the sequencing of the policy works, that the price signal, the demand signal, demand creation is there. So we're doing a lot of work at the Transition Finance Council on that, and on ensuring, we've just published a transition finance playbook for sector transition planning, ensuring that finance is written in there right from the start. So I think the other two areas, transition planning, super important in the UK, already working through the market. So that's building into your strategy, not necessarily doing a super duper disclosed transition plan. We're still talking about that. And the other issue is taking the public money that we've got and using it strategically. We've got lots of little pots. We need to tidy it up and have a plan. And that's coming through too.
Thanks a lot.
If you allow me, just to vouch for what Vanessa is saying, there's a clear, clear sign that we see in the UK about what you're addressing, that there's a proactive government on those topics that is capable of addressing our issues, making sure that we want to bring our capital to the UK to further that purpose that you have. So, I always ask for more from politicians, but I have to say I've been impressed by the UK lately, and very few countries have such an advanced agenda and have the means to address asset owners like ourselves. So, well done.
Okay, compliment to the UK there, and some work that needs to be done for Switzerland, Canada, the US probably. Talking about the US and the opportunity set, which market in particular, you're covering a lot. You're covering, as I mentioned, from credits to real assets, the whole range. Which opportunities, and it's not an investment consult to the audience, which topics are you most excited about at the moment? You mentioned one already a bit, but talk us through 2 to 3 examples, please.
Absolutely, and with the majority of my answer, I'm going to connect it back also to the question of what do we want from regulators as well, right?
Perfect.
I mean, let me just say, it's an extremely, in short, if you're looking for just like a 2-sentence summary, I think at the moment we find ourselves in the United States, I think for energy and industrial transition focused investors such as ourselves, it's a more challenging environment to raise capital, given the uncertainties and the noise of the moment. But it is paradoxically a much more attractive moment to deploy capital. It is when there are market dislocations, what I would call air pockets in the market, and investment tourists leaving the market because they look at the headlines and they say, oh, the energy transition is canceled. It is those moments that you sow the seeds of extremely compelling returns 5 years from now, 10 years from now, when we look back at this period. We will look back and say, oh my goodness, the Trump administration, term 2 was actually an incredibly attractive, vintage of investment into the energy transition. And it really connects with what you were saying about renewable assets. If you believe in this as a long-term value creation story. We're seeing that across asset classes. We believe that opportunity is there in an even more pronounced fashion, I should say, in the near term, probably in credit. And in doing things that are actually, I should say, distinct, to connect this to kind of a broader dialogue in capital markets as well. We think the real opportunity to do it is not in senior debt and is not in just traditional formulaic private credit. We think that this kind of flexible, mezzanine debt, really interesting, creative capital solutions are where you're going to get a really attractive risk-reward ratio, risk-return ratio, in this segment, in particular in the US, to some degree Canada, to some degree Europe as well. Across the board globally, we also think that there's a really interesting set of opportunities in public markets, both in terms of just returns. So, just without going into details, I'll just say it's the most prolific year to date for our public equity strategy, the first 6 months of the Trump administration, and there's some kind of an interesting story there, which is that we've gone from sort of climate climate beta is just something you want to be passively exposed to. Anything green coming out of Glasgow, right? Heading into the Dubai COP28, anything green was golden. And you could just sort of say, I want a basket of the top 30, renewables, publicly listed, companies, and just give that to me, and I'll ride that out. It's really a stock picker's market right now. It's a market where you have to go hunt and find energy transition alpha. But for those that are willing to be active managers looking to find it, we think that the returns are extremely attractive. And that is because the public markets have reacted in a very, actually quite dramatic fashion to headline risk and to some of the noise in the system. And that creates opportunities to capture value. Across the board, though, to connect it back to where regulators come in and where the US, frankly, is falling short, data. We're in the business, ultimately, of creating value from data and high-quality information. And we think that things like Senate Bill 253 in California, things like the climate disclosure regulations and provisions in the EU are extremely important for both equipping asset managers, but also asset owners with the ability to be better owners of assets, to be better custodians and stewards of the capital that they oversee. But it also creates just new opportunities, new business models. A lot of the businesses that we're invested in from a venture growth strategy perspective are ultimately actually very capital light, what we would call the controls layer of decarbonization, the controls layer of the energy transition, which is who is the sales force for sustainability, right? Who is the Microsoft Office suite for identifying what your scope 1, 2, and 3 emissions are, identifying which are the solutions in your value chains and your supply chains that pay for themselves, and where are your supply chains most at risk from climate impacts, and how do you mitigate those, right? There's a whole suite of business before thinking about that as an important question and acting on it within your enterprise. There are a whole suite of business models to be developed that are starting to spring up, of new unicorns, new billion-dollar companies, right, that will be at that interface. So we believe that regulators have a real role in ensuring that the best quality, highest integrity data is coming to market and is being brought forward in as efficient and as least bureaucratic of a manner possible, so that corporates continue to see this as in their interest and continue to invest in it, in conjunction with regulators asking for it.
Thanks a lot.
Can I challenge?
Sure.
Because SEC Chair Atkins just yesterday or the day before just said, no more quarterly reporting, but none of these ESG BS, quote unquote, which goes exactly in the opposite direction of what you're advocating for, right?
Which is why I'm not afraid to say that this is an area where the United States has quite a long way to go, and we're going, unfortunately, in the wrong direction. But I will say it's the reason I mentioned California, and it's when you sort of ask yourselves, okay, like in my boss, my former boss, Secretary Kerry, is fond of saying that in the first Trump administration, the United States government left the Paris Agreement, the people of the United States did not. And that's actually largely because a plurality of US GDP in the form of 2/3 or more of the states actually continued to advance on climate policy. And it's the reason why the Trump administration ended with 75% of marginal additions to the grid being renewable, right? It's the reason why we had new zero-emission vehicle standards during the first Trump administration. It's because of the federal nature of the US government and the role of states as what we call laboratories of innovation. In this case, we think, coalitions of sustainability going forward. So I think there's pronounced importance right now on states like California, like Oregon, like Washington, not only continuing to move ahead, but working together to make sure that they are as harmonized as humanly possible among themselves as US states, and ultimately also with, let's say, EU and UK regulators, so that enterprises are not looking at this and complaining about a patchwork of different climate disclosure laws, but they say, oh, there's a future-proofing regime that we actually want to voluntarily plug into and follow, even if we're not in one of those states, because we see the direction of travel.
Okay, thanks for this answer. I mean, on a much smaller scale, but in Switzerland, it's a bit the same when it comes to regulation. We have regional laws, especially in the real estate area. So also from a pension point or a long-term investor point of view, you could see the risk that, for example, and it's already happening in Switzerland, that Geneva has a much stricter policy when it comes to fossil heating systems compared to another canton, let's say Bern. So this is a risk also in Switzerland that is there for all of us. Maybe switching to Emmanuel and talk a bit about infrastructure. For me, infrastructure, I see there are different types of infrastructure, but when it comes to energy transition, I see on one hand the brownfield, the traditional infrastructure we all know that needs to be transformed, and then you have the greenfield, the the fast movers, to go back to this topic, which have a different angle. So how do you balance that out on a portfolio, and where do you see the biggest challenges in both areas?
It's greenfield, nothing to do with green. It's greenfield. It means it's flat land and you build an infrastructure on it. It's a big challenge for a pension plan because it comes with development risk, permitting risk, construction risk. Are we gonna have a client? Are we gonna have the contract? It's a lot of question marks. So it takes a lot of energy, people's energy, alpha, I would think, in using my asset manager language, to allow yourself to invest in greenfield projects. And then when you fail, you get a big backlash. So how do we do it? We do quite a bit of it in the infrastructure portfolio like this because it's value generative. We think building the right infrastructure is actually easier than fixing existing infrastructure. We just sold, fortunately, a big oil pipeline crossing the US, and it was 100 years old. It kept on leaking. It had a cyber attack. We spent a lot of time fixing it with our partner there, and we couldn't see the end value of this. It's too small to put water. Why would you want to bring water from Louisiana all the way to New York? I mean, there was no business case for an alternative value. So, again, thank you to Trump. It was the right time to sell it. No pride in selling assets, but some assets I don't think we can fix. So why don't we build new ones? And how do you address those risks that typically a pension plan doesn't want to carry? And I think rightly so. So two ideas we came up with is, first one is I was mentioning a good dialogue we have with the UK. We have very good dialogue with the Canadian government, and that's quite obvious. But you want a project. In one case, nuclear power plant. Another one, high-speed train from Quebec to Toronto, going through Montreal and Ottawa as well. Let's sit down. You have smart people in front of you. How do you allocate the risks so it makes sense for me to invest, makes sense for you to invest? You derive the benefit from having some form of private ownership and private management of an asset, which I think brings value as a whole. So it's a matter of how you spring this value creation among all the constituents, taxpayers on one side and pensioners on the other. So this is a kind of dialogue which is rich. It takes people on the government side that have the right capabilities to negotiate with people that are on the private side. We often have the wrong incentive, short-term incentive. Fortunately, in La Caisse, we managed to deal with the incentive issue. We're long-term, we're not getting specific revenue or bonuses based on short-term performance. So we have a good alignment to start with, so that helps this dialogue. But so you design this. So that's the first option, is co-creating through a public-private partnership, if you want, those big projects, and hope you come to Canada one day and you can take the high-speed train, probably towards my retirement. But that's the first option. Second option is, you buy the competency. So you buy a developer. I was mentioning we bought quite a few developers this year, in renewable in particular. It's people who have a track record. Let's talk about the team we bought in called Edify in Australia. It was last week, so it's fresh. It's a team that's been building renewable projects, solar and battery, for the last 10 years. And we've looked at what they've delivered, relatively on time, on budget, well contracted. So for us, it's, as a pension plan, we like to look at data. So we look at past data, and we got convinced that these guys know what they're doing, and they can probably manage some of the construction and development risks that I was mentioning. And so we buy into this competency. We turbocharge them with our capital and some governance. And they don't have to run away around for money. They have the money from us. And we bring our capital, probably some of our Swiss friends' capital alongside us, and we can invest and build those new assets. Incidentally, this first asset that we will build are contracted to Rio Tinto. Rio Tinto is a hard-to-abate emitter, and now they will be replacing some of the coal that they have to make aluminum with this solar plus battery project that we're building. So for me, that's a very virtuous circle. And in all this, we're getting some extra juice, right? Extra alpha for our pensioners, because you get a huge premium in terms of returns when you do this. You have this effort. So absorb here, but that's a two big option that we have at hand.
Thanks a lot. That sounds to me like the holy grail for all of us. No, I think it's all about combining those two elements. Maybe we have around 5 minutes left before we close the session, and you can all have a drink. We would now open our panel to you participants. So if you would have any question, I think the microphones should be on and should work. So please.
Someone of you mentioned the rate of interest in Switzerland, which are now 0%. Shouldn't that have an influence on the speed at which you can renovate building in your pension fund, Jean-Christophe?
Well, we are asset managers, but I would say the Swiss example, having the benefit of now living here 7 years, is the biggest Swiss problem to start with speed is I believe is in the workforce. I don't believe, I know is in the workforce. You have about 140,000 people in Switzerland who work in the construction industry that could help. And the national statistics are that you'd need another 190,000 if you were to actually be able to do all the transformation of buildings that is required by the new legislation coming in. So that's to start, and then I'll let a true pension plan comment as it relates to perhaps the economics and the other challenges there too. But one is the workforce.
Yeah, I would agree on that. Jean-Christophe, your thoughts?
So, of course, because of the zero rate, it has an impact on the cap rate we have on the real estate. So, of course, we increase the value of our real estate based on different valuation we have. The issue we face on the renovation is we have quite an aggressive objective of renovation. And for the moment, we are not able to reach the limit and the budget we were supposed to spend. So for the moment, it's not a question of to speed up. It's just the question to stay on our objective, because we really want to have a clear climate strategy and to stick to our roadmap. And for the moment, it's really where, because of the permit, which slow the process. So we have to discuss with the government and everything. But for the moment, it's more a question of that. But of course, you're right. If because of the zero rate, we can increase the value. Yes.
Mm-hmm. But on the other hand,
is finally rates are coming down in Europe, so you will see the valuation increases coming in Europe following Switzerland.
I mean, it's good for your portfolio, but as Jean-Christophe mentioned, on the other hand, if you want to start, if you have new money to deploy, the price is not cheap for Swiss real estate. There was also another question, I think.
Hello, Chris Kuczynski. I have a question which is probably mostly to Jolt and to Emmanuel. We've discussed about investing in real estate. I'd like to take a step back from one building to the level of the city. And what we see already for a long time is the migration of populations from countryside to the cities. And it's only going to be amplified by the climate change. And a lot of those cities, especially in the emerging countries, are really badly designed. There is limited zoning, limited walkability, etc. So do you see that as a risk or an opportunity from the investment perspective mostly? Thanks.
We're so polite. We're probably looking for the answer. It's not an easy answer, right? I think that every time the global South Metro policies get discussed, the solutions are pretty rare on the ground, and there's a lot of problems. One of the biggest problems, and I forget the gentleman's name, Hernando de Soto, I think, won a Nobel Economic Prize for this. That one of the biggest problems is that there's a lack of legal ownership on most buildings in some of these cities, and when you have lack of legal ownership, then you can't have a mortgage, so you're not getting that replicating effect where you could create enough value that you could then perhaps do works on your home and make it more sustainable. But we have a massive issue in general, with the global mega cities. There's water shortages, cities are sinking like Mexico City and so on, and it's not something we spend enough time on focusing on, is my honest answer.
Thanks. Emmanuel?
Slightly more positive, on my view, it's an opportunity, both on the developed world, because there's still some urbanization happening, and in Montreal, for instance, we're building a light rail, and we're, part of the financing of this project is through development, real estate development and residential development. So if you come to Montreal, there's, every station that we've built, there's skyscrapers now, and each of the person has paid a portion of our transport system. So that's one of the way we address it in infrastructure. In emerging market, I think it's slightly better organized than what we perceive. In Delhi, I have an office in Delhi, and we own part of the roads circling around Delhi. There's some government planning, probably not at the macro level, but at the district level. They organize new neighborhoods. They don't mind destroying things, and sometimes we would object, But unlike we have in Europe, where preservation of historical building is core, we have the same in Canada. In China, they raise an entire neighborhood and they rebuild it to the taste of the 21st century. In India, I see the same happening. They want a new road, they build a new road, and some things get built. So there's enough planning to have those urban centers. It's not as good as what we have elsewhere, but they kind of manage the demographic. I think it's not that. It's a great opportunity for us to invest in infrastructure.
Thanks a lot. We have time for one last question. There was one, yeah?
Thank you. We heard from David Livingston how investing in this transition is very much linked to active investment management. Now with Swiss pension funds, we see a strong trend towards passive investing. A question to Jean-Christophe. How can we refocus the perception of Swiss pension funds from purely costs to cost benefit?
I think there is, of course, the debate of passive versus active for listed equities, but I think for a private market, it's where we can play a big role and to be active in private equity, infrastructure, and real estate. What is really important is, and the pension fund need to pay a lot of attention to the way they want to implement that kind of asset class. Of course, there is a cost, but there is also the risk that is not properly implemented. So you look at the private credit and the bankruptcy we have a few days ago. We talk private debt is an interesting asset class, but you need to be in good hands, and you should not underestimate how much resources for real estate, infrastructure, or private equity the manager need to have. So fees is one thing, but we need really to pay attention to the team you are working, and this is very important. So, but it's where we can play an active role. It's where we can show the result, like transition energy in infrastructure. It's really a concrete example of what we can do. So I think we need to show our example of that kind of strategy, especially infrastructure.
Yeah, thanks a lot. I need to close here in order to respect the schedule, but also maybe one thought there. I think it's also, again, a question of balancing out. I mean, you can do passive investing and have an active stewardship engagement, for example. So I think, but what I get from our panel is, I think the opportunity set really is there. It's in our interest as long-term investors. We will see a lot of exciting opportunities. They are ahead. It's here to stay. We should not forget about the risk. You mentioned private debt. There are some risk around the corner, and we should maybe follow the UK example of how to do a smart regulation sector-wise and bringing all participants together. So that's from me. Thanks a lot for joining, everybody, and I wish you all the best. Have a safe trip home, and drinks next.